Fitch affirms Egypt at B+, outlook stable. Macro performance, reforms and international support. Egypt's ratings are supported by its recent record of fiscal and economic reforms, its large economy with robust growth and strong support from bilateral and multilateral partners. The ratings remain constrained by weak external liquidity metrics amid still substantial reliance on non-resident investments in the local bond market, large fiscal deficits, high general government debt/GDP, and domestic and regional security and political risks. Reserves lower on portfolio outflows. Central Bank of Egypt (CBE) reserves dropped by $4.7 billion to $35 billion in March 2022 after portfolio outflows and CBE interventions to smooth exchange rate volatility. At an estimated 3.7 months of current external payments, reserve coverage is now weaker than the B median. CBE's foreign currency (FC) assets not in reserves, mostly deposits at local banks, which used to be an important backstop, also declined by $7.6 billion to $1.5 billion. Foreign holdings of Egyptian pound-denominated government debt dropped to $17.5 billion by mid-March, a decline of $11 billion from end 2021 and $16 from their all-time high in September 2021. CBE liabilities are mostly medium to long-term. The CBE's net foreign assets remain significantly weaker than gross reserves, declining to a negative $5.1 billion at end March from $8.6 billion in February, the lowest level since 2016. However, CBE's liabilities are medium to long-term in nature and have repeatedly been rolled over, and we continue to view gross reserves as the most relevant indicator of Egypt's external liquidity. Aside from GCC deposits, CBE liabilities include a currency swap with the People's Bank of China and repurchase agreements with international banks. Bank external position also weaker. Bank NFA had weakened markedly prior to the Ukraine shock as public sector banks in effect funded Egypt's current account deficit and maturities, keeping CBE reserves stable. Bank NFA fell to a negative $12 billion in February 2022. March figures are unavailable, from an asset position of nearly $7 billion in February 2021. Local banks appear to have drawn down on their external assets in part to increase their holdings. Egypt's FC bonds, which have increased by more than $9 billion in the financial year to end June 2022, FI 21/22. Swift international support. CBE reserve figures for March already reflect a $5 billion deposit from Saudi Arabia in March and a $3 billion deposit from the UAE in February, bringing total GCC deposits to about $20 billion. Abu Dhabi also bought $2 billion in listed local equities from Egypt's government. In addition, Qatar and Saudi Arabia have committed a $5 billion each in a combination of deposits and investments. Egypt is in discussions with the IMF on a new program, which we expect will be funded. Prospects for recovery of portfolio flows. Non-resident portfolio holdings stabilized in the final week of March, and we assume some recovery to $20 billion by end FI 21/22 and $25 billion by end FI 22/23, helping restore Egypt's gross external buffers. A 14% depreciation of the Egyptian pound against the US dollar in March, a policy rate rise of 100 BP on March 21, GCC support, and a new IMF program will support investor confidence, in our view. Current account pressures manageable. We expect the current account deficit to narrow to 4% of GDP in FI 21/22, $18 billion, and 3.5% of GDP in FI 22/23 from 4.6% of GDP in FY 21. The deficit improved in 2H21 helped by growth in shipping through the Suez Canal, a rebound in travel receipts, and a widening hydrocarbon trade surplus. Travel receipts will likely still be higher in FY 22 than FY 21, despite the loss of tourists from Russia and Ukraine, less than a fifth of receipts. The increase in global food prices and disruptions to wheat imports from Russia and Ukraine will weigh on the trade balance. Fiscal deficits contained at high level. We forecast general government fiscal deficits of 7.4% of GDP in FY 21/22 and 7% of GDP in FY 22/23, from 7.2% of GDP in FY 20/21, wider than the B median. These forecasts are conservative and imply further spending to mitigate the effects of inflation and enhance social protection beyond announced initiatives, which the government expects to accommodate within existing spending allocations and contingency reserves. The central government deficit was 7.1% of GDP, annualized, in July 2021 to March 2022. Solid economic growth. Egypt's recovery continued in 2H21, with real growth of 9.8% YoY in 3Q21, driven both by exports and domestic demand. Goods exports have been supported by natural gas, as well as agricultural and manufactured goods, in particular textiles, and a rebound in tourism and shipping through the Suez Canal buoyed the services sector. Domestic demand has been supported by a continued loose fiscal policy, including public sector investment. We forecast 6% growth in FY22 and 4.5% in FY23, although tighter monetary conditions pose significant risks. Reforms continue despite challenges. The government continues to work on boosting tax revenue, but progress is slow. In FY 21/22, we expect tax revenue/GDP to fall to 12.8% from 13.2%, with the government falling behind on a previous target to raise the ratio by 2 pp between FY 20/21 and FY 23/24. Amendments to the VAT law passed this year will expand the tax base to include e-commerce activities. A new customs law came into force in October 2021. Previous subsidy reforms have been resilient in the face of higher inflation. Debt high, but falling. We expect government debt/GDP to fall to about 91% in FY22, from 92% in FY21, and to remain on a slight downward trend, despite the impact of currency devaluation. Egypt has an established record of surpluses in recent years, but weaker growth presents a risk to the debt dynamics, particularly amid higher interest rates. Debt metrics are well above B medians. However, more than half of government external debt is owed to multilateral institutions, with which Egypt has good relations, and the large domestic banking sector is a captive investor in local currency debt. Inflation, monetary tightening, higher oil and food prices have driven a surge in inflation. Overall consumer prices rose 12% YoY in March, driven by food, 34% weight, up 20%, and electricity and fuels, 4.5% weight, up 11%. CBE's headline urban CPI reached 10.5% in March 2021, above the 9% upper limit of the CBE's target range. We expect price pressures to accelerate further after exchange rate depreciation in March, lifting overall inflation to 10% in FY22, July 2021 to March 2022, 7.8%, and 12% in FY23. In our view, the CBE is likely to raise interest rates further to maintain positive real policy rates, tame inflation, and support the Egyptian pound and attractiveness of local currency assets. We assume a further 300 BP in rate rise by FYE 23/24. Political, social risks. The potential for political instability remains a significant tail risk, in our view, given structural problems, including deficiencies in governance and high youth unemployment, particularly in a high inflation environment. Although the headline overall unemployment rate has fallen, this is against the backdrop of a low and falling participation rate. The government has sought to mitigate this through targeted social spending and economic reforms, while the space for political opposition and freedom of expression is restricted, in our view. ESG Governance. Egypt has ESG relevance score of 5 for both political stability and rights and for the rule of law, institutional and regulatory quality and control of corruption. FEC's scores reflect the high weight that the World Bank Governance Indicators, WBGI, have in our proprietary sovereign rating model. Egypt has a low WBGI ranking in the bottom 23rd percentile. Rating sensitivities. Factors that could, individually or collectively, lead to negative rating action/downgrade. External finances. Renewed signs of external financing strains, including downward pressure on international reserves and rapid outflow of non-resident portfolio investments from Egypt's financial system. Public finances. Failure to resume a path of narrowing the fiscal deficit and reducing government debt/GDP, for example, due to higher interest rates and weaker growth. Macro. A prolonged hit to economic growth and/or backsliding on the country's economic reform program, which could result in greater risks to macroeconomic stability and could undermine progress on debt reduction. Factors that could, individually or collectively, lead to positive rating action/upgrade. Public finances. Sustained progress on fiscal consolidation leading to a further substantial reduction in the gross general government debt/GDP ratio to a level closer to the B median over the medium term. External finances. Reduction in external vulnerabilities, for example, through lower dependence on non-resident portfolio flows, narrowing of the current account deficit, and buildup of international reserves or other liquidity buffers. Structural. Significant improvement across structural factors over the medium term, such as governance standards, the business environment and income per capita, to levels closer to B and BB rated sovereigns. Sovereign Rating Model, SRM, and Qualitative Overlay, QO. Fitch's proprietary Sovereign Rating Model, SRM, assigns Egypt a score equivalent to a rating of B+ on the long-term foreign currency IDR scale. Fitch's Sovereign Rating Committee did not adjust the output from the SRM score to arrive at the final long-term foreign currency IDR. Fitch's SRM is the agency's proprietary multiple regression rating model that employs 18 variables based on 3-year centered averages, including 1 year of forecasts, to produce a score equivalent to a long-term foreign currency IDR. Fitch's Qualitative Overlay is a forward-looking qualitative framework designed to allow for adjustment to the SRM output to assign the final rating, reflecting factors within our criteria that are not fully quantifiable and/or not fully reflected in the SRM. Best/worst case rating scenario. International scale credit ratings of sovereigns, public finance and infrastructure issuers have a best case rating upgrade scenario, defined as the 99th percentile of rating transitions, measured in a positive direction, of 3 notches over a 3-year rating horizon, and a worst case rating downgrade scenario, defined as the 99th percentile of rating transitions, measured in a negative direction, of 3 notches over 3 years. The complete span of best and worst case scenario credit ratings for all rating categories ranges from AAA to D. Best and worst case scenario credit ratings are based on historical performance. For more information about the methodology used to determine sector-specific best and worst case scenario credit ratings, visit https://www.fitchratings.com/site/re/10111579. References for substantially material source cited as key driver of rating. The principal sources of information used in the analysis are described in the applicable criteria. Esg Considerations. Egypt has an ESG relevance score of 5 for political stability and rights, as WGBIs have the highest weight in Fitch's SRM, and is therefore highly relevant to the rating and a key rating driver with a high weight. As Egypt has a percentile rank below 50 for the respective WBGI, this has a negative impact on the credit profile. Egypt has an ESG relevance score of 5 for rule of law, INST and reg quality and control of corruption, as WGBIs have the highest weight in Fitch's SRM, and is therefore highly relevant to the rating and a key rating driver with a high weight. As Egypt has a percentile rank below 50 for the respective WGBI, this has a negative impact on the credit profile. Egypt has an ESG relevance score of 4 for human rights and political freedoms, as the voice and accountability pillar of the WGBIs is relevant to the rating and a rating driver. As Egypt has a percentile rank below 50 for the respective WGBI, this has a negative impact on the credit profile. Egypt has an ESG relevance score of 4+ for creditor rights, as willingness to service and repay debt is relevant to the rating and a rating driver, as for all sovereigns. As Egypt has not restructured public debt for more than 20 years. This is captured in our SRM variable and has a positive impact on the credit profile. Except for the matters discussed above, the highest level of ESG credit relevance, if present, is a score of 3. This means ESG issues are credit neutral or have only a minimal credit impact on the entity, i.e., either due to their nature or to the way in which they are being managed by the entity, i.e.